What's going on, guys? Happy New Year. Welcome back to the channel. Today we are talking about Tesla, and if you're new to the channel, make sure you hit that subscribe button. I do stock analysis videos 3 times a week and sometimes more if I'm feeling really generous and really hot on the market. But today we're talking about Tesla. This company has been getting hit hard over the last little while. We have it loaded up here in the stock spec software. So what we're going to do, folks, we're going to go through the numbers of Tesla and eventually find the intrinsic value of this business, so you have an idea what you should be paying for this company today if you are looking to invest into this business. And if you are currently invested, this is where this company stands, and this is my opinion on it. So here's what I like about Tesla. One, the price going down. If you're in this company, you should be happy about this. I'll tell you why. If you truly believe in this business, folks, this price decrease that we've seen at the high of, let's say, in 2021, or even the 52-week range here, folks, take a look at that. 52-week range, a high of $402, a low of $108, currently sitting at $123. If you believe in this business, this company is on sale. So let's take a look at this, guys. We're loading this up here, and in the financial evaluations, we are ranking this company a 5 out of 10. Now, for those who are new to the channel, what this software does, it takes a look at the company's financial statements, so their income statements, balance sheets, and cash flow statements, and grades it out of 10 based off certain criteria if the company is hitting those marks. Tesla's score 5 out of 10 is not great. Let's take a look at the things that they are doing right and the things that they are doing wrong, starting off with the bad. The bad with Tesla is their 5-year price to earnings ratio, currently sitting at 627.62. That means the company on average has been trading for a high premium in regards to the earnings that they've been bringing in. Now, you take a look at the trailing 12 months price to earnings ratio, it's currently at 34.63. This, although a little bit higher than what we currently want, we want to find companies that have a price to earnings ratio of 22.5, which is more of a decent multiple. It's still a little bit high, but way more attractive than the 627 that we've currently been shown. Along with that, their current ratio is 1.46. They have just enough assets on hand to cover the liabilities. However, I like finding companies that have a current ratio of 1.5 and higher. The return on equity on average is low, sitting at negative 11%. However, not terrible for the trailing 12 months, as it is at 31. So here's the thing with Tesla. They've essentially been turning themselves around from 2019 going forward. So if you were investing in this company 2019 and prior to that, essentially you're overpaying for a company that wasn't really making money at all. 2019, however, was the turning point for this business, so now things are getting interesting. As well as for the negative news on this company, their share dilution is up by 2.71%. That means they've been adding 2 shares over the last 5 years. Not great. We want to find companies buying back shares, granted if they're reasonably priced, because sharing is not caring, folks. That means you are sharing the profits of the business with other investors. You don't want that. And finally, the return on invested capital average is negative 4.03% on average. And that's not great. We want to find companies that have a return on invested capital average of 10% or higher. That just indicates that they have a decent return on the money that they're obviously investing. Now, the other 5 things that this company is doing right is their EPS growth is up over the last 5 years by 86%. Pretty decent, very modest. Their debt to equity ratio is incredibly low, 22%. That means they're leveraging their capital through equity and not through debt. However, the caveat to that is the share dilution that we discussed earlier. Along with that, their net income is up, their free cash flow is up, and their revenue growth is up. So it's a 50-50 split with Tesla. Now, it depending on what kind of investor you are, you may be able to overlook this high PE ratio average. As I said, it's currently at 34. That's a much more attractive price or earnings ratio. Their EPS is up, which is great. Their return on equity, really high. 31% is awesome. It'll be a while until they'll be able to make new averages, but they're currently at that turning point. Now, what should we be paying for this company? I'm going to fill out these lovely boxes and we will find out an average price to pay for this business. And folks, if you haven't done so already, hit that like button and subscribe button to get your hands on the software that I'm using. Follow the links in the description box below There's a 7-day free trial, and I'm just scratching the surface. This is probably the main page you're going to use to analyze stocks instantaneously, and just take a look at the runtime of this video. You already know where this company stands numerically, and you're going to eventually find out what you should be paying for it. So the current price is $123, and our average calculation comes out to be $91. Now this is assuming a very, very lenient, I gotta say, revenue growth percentage increase over the next 10 years. This company, if you remember, at one point it was $1 trillion company. Now it's currently just south of $400 billion market cap. So they obviously are increasing the amount of production that cars are being outputted. However, they do have competition. They have Volkswagen and Ford and GM nipping at their heels. Can they match those numbers? Well, we'll have to find out. But putting 20% revenue growth over the next 10 years, I think that is quite possible. I might want to decrease these numbers. You know what? I'm going to try 15. It's not going to really help the case of what's going on, but I'll go 15, 17, and 19, and just to see what that comes out to be. Because right now, the average calculation comes out to be $91.01. This is going to probably, and it's going to drop it by a considerable amount. You might believe those revenue growth numbers are 20, in that 20-ish range. I think this makes a lot more sense going forward if I want to stay in the conservative range. Essentially, $65 is what we should be paying for this company going forward. You have to keep in mind, folks, these other car manufacturers that exist are able to turn over more units, and as electric vehicles become more mainstream and easier to produce and much more cost efficient, you have to try to figure out a spot where Tesla might be in the market. Right now, they are the forefront of these electric vehicles, but who's to say that they will be that company going forward? Our goal is to be rational value investors. What are my thoughts on Tesla? From a numerics perspective, I don't like this board at all. If the stock price comes down to about this 60 range, that's something I might want to pick up. But I need to see where this company goes in the next year or so. Right now, I want to see more green. So just to summarize and keep it brief, I want to see more green on the board here. I need to see this price come down as well for it to be somewhat in my wheelhouse. It's still a little bit overvalued, but I think it might it has the potential of being a solid company later down the line. However, I just don't want to overpay for it. That's the video, folks. If you enjoyed the video, make sure you hit that like button and subscribe button. And for the software, as I said, follow the link in the description box below. It pays for itself. And look, we're not even at 10 minutes, guys, and you already know what you should be paying for the company and what it's all about. I will see you in the next video. Thank you so much for watching.